It's Monday, January 17th. This is the Daily Market Comment by Mario Sechikiriakos. I'm Christina Marujos, and thank you for joining us here at XM.com. Markets are growing increasingly confident that the Fed will raise interest rates 4 times this year to bring inflation under control, even though the latest edition of U.S. retail sales on Friday disappointed in a massive way. That wasn't enough to sink the dollar. Instead, the dollar recovered, empowered by rising Treasury yields, as traders placed more emphasis on some remarks by Fed officials that Omicron will be inflationary and rate hikes are imminent. A spike in survey-based measures of inflation expectations likely added fuel to the moves, along with the CEO of J.P. Morgan Chase, who warned during the bank's quarterly earnings call that there could be 6 or even 7 Fed rate hikes this year. This seems like a stretch, but it underscores that there's still some room for market pricing to grow more hawkish, fueling the next leg of dollar strength. After all, the U.S. labor market has arguably crossed the full employment Rubicon already. In contrast, China has embarked on an easing cycle. The People's Bank of China cut its key policy rate by 10 basis points today to juice up economic growth, which has taken a sharp hit thanks to the property crisis and draconian lockdown measures in some regions. But the market impact was negligible, with only local stock markets reacting positively. The Australian dollar didn't even notice, and perhaps that's a signal that the rate cut wasn't big enough to move the needle for growth. Beyond growth risks, another crucial question is whether the recent lockdown measures across China will deal another blow to distressed supply chains, keeping global inflationary pressures elevated for longer. The next big event for markets will be the Bank of Japan's policy decision early on Tuesday. No policy changes are expected, although the bank could strike a slightly more optimistic tone, drawing confidence from improving economic data and the enormous spending package the government is about to unleash. But don't expect the Bank of Japan to signal rate hikes are coming anytime soon. With the Bank of Japan likely to be the last major central bank to raise interest rates this cycle, the outlook for the yen remains negative from a relative monetary policy perspective. That said, any losses might be smaller than last year if volatility episodes in the markets become more frequent, allowing defensive assets like the yen to enjoy brief periods of strength. Thank you for watching today's Daily Market Comment here at XM.com. Have a great week.